All right, guys. So the purpose of this session, guys, is to revise the entire bond valuation chapter. There'll be no problems that will be solved during this revision session. The objective is only to explain briefly the concepts again. The concepts will not be dealt in a very detailed manner. So G Drive students, keep that in mind, or whoever is listening to this video. In case you have the concept notes with you available, it's better that you open those concepts note so that we can refer to those notes better now. So starting off, guys, with bond valuation. कहाँ पे ये? Yes, beta. Oh my god. Yes, guys, starting off with bond valuation. I said it does not matter which security are we going to value, guys. The value of any security will always be the present value of future cash flows. You're supposed to consider future cash flows, discount them as such, guys, at the required rate of return. So when you talk about a bond, the cash flow that you're going to receive from a bond will be in two forms. One is the amount of coupon payment that you're going to receive every year. The other one will be the redemption value that you're going to receive at the end of the maturity period. So for this, beta, you should know what is face value, you should know what is coupon rate, and you should know, guys, what is the, one second, you should know your face value, you should know your coupon rate as such, beta, and you should know what is the redemption value of the security. Coupon rate is always computed as a percentage of your face value. So once you have coupon rate, once you have face value, once you have redemption value, you will know what are the cash flows that are being generated from a bond. After that, guys, the other variable that we need for valuation of a security, guys, is your required rate of return. I said required rate of return is always based on the risk that is involved in the security. Higher the amount of risk that we take, higher should be your expected return. This in respect of a bond, a debenture, beta, is determined using credit rating. You have risk-free rate, that is the return that you generate on government securities, and then the credit rating of a company will tell us how much risk premium will the investors be expecting. A AAA rated bond as such, beta, will have a difference of about 0.4, 0.5% from your risk-free rate. A AA rated bond might have 1.5%. A A rated bond can have a difference of 3%. You do not have to remember those AAA, AA and A rated bond ke yields, guys. You just have to know that it is risk-free rate plus risk premium. This difference, beta, is also known as spread. We have come across the word spread, beta, in few questions. If they say that the spread of a AAA rated bond is 1%, that means it is 1% more than the risk-free rate. The spread is the difference in yield in any two bond rates, guys. So once you know what are the cash flows that are being generated out of a bond, once you know what is the required rate of return, guys, the value of a bond will simply be the present value of coupon payments plus the present value of redemption value. For this purpose, we have divided bonds into different categories, guys. The first one was a coupon paying bond. If the bond is something that pays an annual coupon, you will write coupon amount into present value annuity factor plus redemption value into present value factor. So if there is a bond with a face value of 100 rupees and let us say coupon rate is 8%, maturity period is 5 years. Your cash flow every year will be 8 rupees. That 8 rupees I will have to multiply by present value annuity factor at R% for 5 years plus unless otherwise given, it is always redeemable at par value. So you will write 100 rupees multiplied by present value factor at R% for the 5th year. This is the present value of a coupon paying bond. After that, beta, we did present value of a zero coupon bond. A zero coupon bond or a deep discount bond does not pay any interest. It is issued at discount to face value and is redeemed at par value. That is why to arrive at the present value of a zero coupon bond, you will simply write present value of redemption value. It will be redemption value divided by whatever is your required rate of return whole power n, or redemption value multiplied by present value factor. That is how you will arrive at the value of a zero coupon bond. After that, beta, we did the value of a semi-annual coupon bond. A semi-annual coupon bond, beta, will give us coupon payment every 6 months. अभी जो ऊपर का example था, beta, 100 rupees face value, 8% coupon rate. If the same bond was a semi-annual coupon bond, how much amount will you receive? 4 rupees. 8% is your annual coupon, guys. So you are going to receive 4% every 6 months. So the value of a semi-annual bond, beta, will become 4 rupees into PVAF. If your required rate of return, guys, let us say is 10%. If required rate of return is 10%, you have to divide that also by 2. So it will become 5%. If the maturity period is 5 years, how many semi-annual periods are you going to take, guys? 10 semi-annual periods. So that will be semi-annual coupon multiplied by present value annuity factor at R by 2% for 2n periods. Plus whatever is your redemption value multiplied by present value factor, guys, at 5% for the 10 period. If the cash flows are on a semi-annual basis, you have to compulsorily divide your required rate of return also by 2. If the cash flows are on a quarterly basis, you will divide your discounting rate by 4. Directly divide, there is no concept of effective interest rate here. Are we clear? By default, 10% would mean 10% compounded semi-annually. If the cash flows are arising on a quarterly basis, by default it would mean 10% compounded quarterly. After that, beta, we moved on to, sorry, I missed perpetual bond in between. There's perpetual bond, beta. A perpetual bond will never be redeemed until the company is liquidated. So there will not be any redemption value. You will only have coupon payments. Because you have only coupon payments, the value of a perpetual bond will be equal to the present value of all coupon payments. Because the coupon payments are going to remain constant, you will write that as present value of constant perpetuity. Formula kya present value of constant perpetuity ka? It will be cash flow divided by required rate of return. That is why for a perpetual bond, you're going to write coupon amount divided by required rate of return. This is how you're going to arrive at the present value of a perpetual bond. Are we clear about this? After that, beta, we moved on to, a convertible bond. A convertible bond, guys, what we are covering in the syllabus is a bond which at the option of the holder will be convertible into a fixed number of equity shares. So let us say that the face value of the bond is 100 rupees. The question says that this is convertible into 5 equity shares. So on maturity, you either get to choose that 100 rupees or you get to choose 5 equity shares. A rational person would select the alternative that is giving him a higher benefit. So that is why, guys, for this you need what is the redemption value or you need what is the conversion value. But this conversion value is not as on the current date. This conversion value is as on the maturity date. You are not exercising the option to convert as on the current date. You will be doing it only on maturity. So even if they give us price of the equity share as on the current date, they will give us a basis to compute price of the equity share as on the maturity date. Without doing that, you are not computing conversion value. First, arrive at expected market price. So let us say, beta, it is 100 rupees or it is 5 shares and expected price of each share is 30 rupees. So which one will you select? Will you select 100 rupees cash value or will you select 150 rupees worth equity shares? 150 rupees worth equity shares. That is why to value a convertible bond, you will still take present value of all coupon payments. But instead of simply writing redemption value, you will write redemption value or equity conversion value, whichever is higher. That multiplied by present value factor. This is how we are going to arrive at the present value of a convertible bond. The last one that we did under valuation of bond, beta, was floor value. I said even if the value of equity share continuously decreases, the value of a convertible bond will not go below a specific limit. And that specified limit is called as your floor value. So if the value of equity share decreases also, are you not guaranteed of redemption value? So to compute floor value, you will have to take only coupon payments and redemption value. Ignore conversion option. We are not bothered about conversion option. You will write present value of interest payments plus present value of redemption value. This is how you're going to determine floor value of a convertible bond. Are we clear about this? After this, beta, we did the concept of computation of yield. इसके पहले जो किए बेटा, we know required rate of return. We were trying to compute fair value of a bond. Now we know market price. We are trying to compute actual return. Not necessary that a bond should always be fairly valued. If a bond is fairly priced, then actual return will be equal to your required rate of return. But if your bond is not fairly priced, if it is overpriced, your actual return will be less than required rate of return. If a bond is overpriced, matlab you are paying more. If you pay more, will you get a lesser return or will you get a higher return? Lesser return. For anything, if you end up paying a higher price, your actual return will reduce. Likewise, if a bond is undervalued, you are paying a lower price it. If you are buying any product at a lower price, will you be getting a higher return or a lower return? This is where your YTM beta will be greater than required rate of return. So under YTM stands for yield to maturity. This is the return that you will generate if you purchase the bond today and you hold it till the end of the maturity period. So this YTM as such beta can be computed either using approximation method or using IRR technique. Approximation method can only be used for a coupon paying bond. It cannot be used for a zero coupon bond or a perpetual bond. It will result in a huge approximation error. So for a coupon paying bond, approximately beta, it is your average annual income divided by average annual investment. You are computing returns for multiple periods. You cannot divide by purchase price. Your amount of investment will keep changing. As a simple example, if you buy a bond today for 90 rupees and the redemption value of that beta is 100 rupees, over 5 years, the price of this bond is gradually going to increase from 90 rupees to 100 rupees. YTM is not the return for 1 year. YTM is the return, average return for the entire 5-year period. That is why you cannot divide it by 90 rupees. You're dividing it by average investment. I am not taking 90, I am not taking 100. On an average, my investment block will be 95 rupees. This is why the formula beta is interest amount. This is your coupon amount plus redemption value minus purchase price. This is the capital gain that you're going to make, but we're dividing it by number of years. I'll just write beta here. Let us say guys, your face value is 100, but you're buying the bond at 90 rupees. Coupon amount is 8 rupees, maturity is 5 years. Every year you're going to get a coupon of 8 rupees. Apart from that, are you making a capital gain of 10 rupees? But that capital gain is a one-time gain. You are not going to get that gain 10 rupees every year. So what will I do beta? Divide that by 5 years. Whole divided by your average investment. This is how you're going to arrive at your YTM. If they ask us to compute post-tax YTM, first compute YTM beta on a pre-tax basis and then you can multiply into 1 minus tax rate. Or beta, you take coupon amounts net of tax. Yaad hai? Whatever was your coupon amount, you will write into 1 minus tax rate plus capital gain also. If they apply capital gain tax, you will have to adjust it from the redemption value. There was one question in which purchase price was 99 rupees, redemption value was 105 rupees. We had a capital gain of 15 rupees, tax on that was 1.5. I said to incorporate tax, directly consider redemption value as 103.5. Problem solved. You are getting 105 rupees from the company, you will immediately pay a tax of 1.5. Your net redemption value will become 103.5. Are we clear about that? Now, using IRR technique, beta, same question, what will I write? 90 rupees should be equal to the present value of all the cash flows. 8 rupees into PVAF plus 100 rupees into present value factor. I will have to use trial and error method to arrive at that rate of return, guys, at which the present value will be equal to 90 rupees. This is how you arrive at accurate YTM. In case they ask us to compute YTM of a perpetual bond, what will you do? No shortcut method. I will directly write current market price, that is purchase price, is equal to interest amount divided by R%. What is missing? R%. That itself is your actual return. You know purchase price, you know interest amount. If they ask us to compute YTM of a deep discount bond, what will you write? Redemption value accumulated balance is equal to purchase price into 1 plus R whole power n. You already know redemption value, you already know purchase price, you already know the number of years. The only thing that is missing is R%. You will arrive at YTM. YTM shortcut formula can be used only for a coupon paying bond. Let us not forget that. For a zero coupon bond or a perpetual bond, you will always have to use present value technique only, but that present value technique itself will give you the answer beta barely in a couple of seconds. Are we clear? Then guys, we did the concept of yield to call. YTC is in respect of callable bonds. In case bonds are issued during periods of high interest rates, organizations might want to include a clause wherein they will be able to buy the bonds before the maturity period. Such bonds are called as your callable bonds. YTC is exactly the same as YTM. Computation, koi change nahi hai. But instead of taking the entire maturity period, you will only take period till the end of call period. If the call period is 5 years from now, you are computing return, assuming that the bonds will be called till at the end of 5th year. That is YTC. Are we clear? Computation exactly same as YTM. No difference. Then we did beta holding period return. we've taken this only in one question, guys, in entire bond valuation. Holding period return is common in mutual funds chapter, not in this chapter. Anyways, holding period return is the return that you have generated over the entire period of your investment. If you have held on to an investment for 5 years, the return that you have generated over 5 years is called as your holding period return. It is not an annualized return. That is why we are dividing it directly by your purchase price. If there is 5 years and you're computing annualized return, I would have divided it by average investment, not by purchase price, like what we did in YTM. So here you will take summation of all your dividend or interest income and then take your capital appreciation. So you purchased a share for 100 rupees, you are selling it for 300 rupees, and you also got dividends of 50 rupees. So 50 rupees is your dividend income, capital appreciation is 200 divided by 100 rupees. This will become your holding period return. It ignores time value component and we cannot use the word per annum after holding period return. Are we clear about this, guys? After asking us to compute fair value, guys, and YTM, the questions can ask us to decide whether it is undervalued or overvalued. I told you, instead of computing YTM and comparing it with required rate of return, preferably compute fair value and compare it with current market price. Conclusion wahi aayega, guys. But YTM computation can have an approximation error. That is why always compute fair value. If they give us actual return, YTM, ask us to compute purchase price, do not use YTM formula. Discount all the cash flows directly at YTM and arrive at present value. Few students had a doubt, sir, why can't we use this bulke? YTM formula mein will take purchase price as missing figure. Isn't this an approximation value? If you do this, your purchase price will not be accurate. Instead, how will you arrive at price of a bond? If price is asked, the only technique that you use, beta, is present value of all the future cash flows. You are not supposed to use these shortcuts to arrive at price. This shortcut is to be used only for computation of YTM. Are we clear about this? Yes or no, beta? So they can ask us to decide whether the share is undervalued or overvalued. These were the first 10-15 questions, beta, that we did. After that, guys, we spoke about the relation between bond value, guys, and interest rate changes. What is the relation, guys? If the prevailing interest rate increases, what will happen to the value of a bond, guys? The value of a bond will decrease. What will happen, guys, if the prevailing interest rates decrease? Value of a bond will increase. If you want a lower return as such, guys, you will end up paying a higher price. If you want a higher return, you will want to pay a lower price. That is why prevailing interest rates are increasing, value should decrease. If prevailing interest rates are increasing, value should decrease. To be better, other way around. They always work in an opposite direction. Are we clear about that, guys? Yes or no? Now, the risk that we take when we invest in the bond as such, guys, is segregated into two categories. First, beta, there is always default risk. When you say default risk, it is the risk that the other party can default. They might not pay us our interest amount. They might not pay us our principal amount. Yes or no? There is nothing that you can do about default risk, guys, other than take insurances for that if you want. But the other risk that arises is interest rate risk. Abhi jo main bola, whenever interest rates are changing as such, guys, it will have an impact on the value of a bond. Interest rate risk is also further segregated into two categories. One is price risk, the other one is reinvestment risk. Price risk is nothing but the impact on the price of a bond on account of change in interest rates, opposite direction. If interest rate is increasing, price will decrease. If interest rate is decreasing, price will increase. All right, guys. Reinvestment risk arises whenever we receive interim cash flows. If I have a coupon paying bond, I will receive some amount of return from the bond every year. Our YTM holds good. I told you, beta, the drawback of IRR and basics of time value of money. IRR will hold good if and only if all the reinvestments are made at IRR. If you are not able to reinvest at IRR, you will not be able to effectively realize that return. So if your YTM is 9%, you will be able to generate 9% if and only if all the reinvestments, guys, are made at 9%. If reinvestments are not made at 9%, guys, your effective return will not be equal to 9%. This is what is your reinvestment risk. Imagine that I've invested in a coupon paying bond. Every year I'm receiving a coupon of 80 rupees. My YTM was 9%. Only if I reinvest this 80 rupees at a return of 9%, I will be able to effectively realize that return of 9%. Now, if there is a change in the prevailing interest rates, what do you think is going to happen to your reinvestment income? It will change. If the prevailing interest rates are increasing, you will be able to reinvest at a higher rate. If the prevailing interest rates are decreasing, you will be able to reinvest at a lower rate. I repeat, beta, they work in the same direction. Unlike price risk mein beta, the relation is inverse, it is opposite. But reinvestment risk, beta, the relation is direct. Increase in interest rates directly will result in a higher income. Decrease in interest rates will result in a lower income. This is where, beta, we spoke about immunization. You can protect against interest rate risk. First possibility that I told you, beta, was invest in a zero coupon bond. I said there are two options, guys. If you invest in a zero coupon bond and you are holding that zero coupon bond till the maturity date, you do not have to worry about price risk. To hell with what is happening in the prevailing market. You do not have to worry about reinvestment. You will effectively realize whatever is the return as such, beta, that you wanted from a security. But if you invest in a zero coupon bond for a period less than its maturity, you do not have reinvestment risk, but you still have price risk. You will not be able to protect yourself against price risk and reinvestment risk. If you are investing in a coupon paying bond for a period equal to its maturity, you do not have price risk, but you still have reinvestment risk. If you invest in a coupon paying bond, beta, for a period less than its maturity, you will have both price risk and reinvestment risk. So one possibility, beta, of you protecting against interest rate changes is to invest in a zero coupon bond for a period that is exactly equal to its maturity period. The other possibility as such, beta, is that you invest in a coupon paying bond for a period less than its maturity. For such a period where your price risk will exactly offset reinvestment risk. And that time period is called as duration of a bond. Are we clear? Duration of a bond, guys, is that time period where your price risk will offset reinvestment risk. To compute duration of a bond, guys, the formula that we have learned in the class was summation xw divided by summation w, where x stands for the year in which the cash flow is arising, w stands for the time period as such, w stands for the present value of the cash inflow. Here's the example. I took the example of a coupon paying bond with a maturity of 6 years, the duration of which was exactly 5 years. This bond was paying us a coupon of 8 rupees every year for the next 6 years, guys. So यहाँ पे x, beta, is the year in which the cash flow is arising. Weight is the present value of cash flow. If you multiply x with w and divide that by w, you're going to get the duration of a bond. Are we clear? I said ICI also uses the same formula. It's just that, beta, that wordings that they use is slightly different, but the end result is exactly same. There is no change, guys, in the formula there also. Are we clear? Now, duration के लिए, duration of a zero coupon bond, beta, will always be equal to its maturity period, because there is no price risk and no reinvestment risk. Duration of a coupon paying bond will always be less than its maturity period. Lesser the value of a bond, lesser will be the duration. You will need lesser time period to recover the amount of investment. If YTM of a bond is very high, duration will reduce, because YTM being high will also result in lesser price of the bond. If it is lesser price of the bond as such, beta, you will need lesser time period to recover the entire amount. Are we clear, guys? After computing duration of a bond, guys, we moved on to the next concept called as bond volatility or modified duration. This is nothing but measuring interest rate sensitivity. When I say interest rate sensitivity, guys, we are talking about what will be the impact of interest rate changes on the price of a bond. To compute modified duration, you write duration divided by 1 plus YTM. So if your duration is 5 years, YTM is 8%, you will write 5 divided by 1 plus 0.08. That is going to give us modified duration or bond volatility. For example, if bond volatility, beta, is 4.5, you write that as 4.5 times. For every 1% change in price of a bond, the value of a bond is going to fluctuate by 4.5%. But will it be in the same direction or opposite direction? Opposite direction. यहाँ पे the example that you're seeing on the screen beta has a YTM, has modified duration of 4.6229 times. So for every 1% change in price, the value of our bond is going to change by 4.6229 times. Are we clear? Now, there was a problem. ये formula है बेटा, percentage change in price will be negative modified duration multiplied by percentage change in yield. I said there is a drawback with modified duration also. Modified duration is nothing but computing slope, guys, on the curve. This curve here will tell us what is the actual price of a bond. This straight line is the price of a bond as per modified duration. All right. Now, this straight line is assuming that the relation between price change, guys, and discounting rate is linear, but the actual relationship is curvy linear. So if there is a higher change in yield, modified duration will result in a higher error. The difference between actual price beta and the price as per modified duration will be the error. To arrive at this error, we have a new concept beta called as convexity. Do you recall that? Convexity as such beta basically measures the price difference between actual and the price as per your modified duration. Convexity adjustment, guys, will always be positive. The price of a, when you say price, this thing, but a convexity adjustment will be positive. As per modified duration, the price of a bond is always going to move in the opposite direction as such, guys. But abhi jo graph bataya main wahan pe, is the price of the bond above the straight line or below the straight line? Actual price of the bond as such, guys, is it above the straight line or below the straight line? Kahan gaya yaar? It was above the straight line. That means to move from price as per modified duration to price as per convexity adjustment, you should always add something. That is where beta we say that convexity adjustment is always positive. How do you compute convexity, guys? It will be V plus V minus 2V naught divided by 2V naught into delta Y square. याद आ रहा है नहीं आ रहा है, guys? It will be V plus V minus beta minus 2V naught divided by 2V naught into delta Y square. This is how you will compute convexity, guys. After computing convexity, we have to compute convexity adjustment, which will be convexity multiplied by delta Y square multiplied by 100. Whatever is your convexity multiplied by delta Y square into 100 will be your convexity. This has come in the examination only once, guys, but it is still covered as a part of your syllabus. It can be asked as a part of MCQs also. That is why you should know how to compute convexity and convexity adjustment. Once we get convexity adjustment, guys, how are we going to arrive at the price of the bond, guys? ये देखो पूरा explain किया था बेटा, you can refer to in notes. So I said actual change in price will be negative modified duration into percentage change in yield. This is change as per modified duration. To that I will always add convexity adjustment. That will give us the change as such, guys, as per the actual values. Are we clear about this? So this was the next concept that we did, guys, in bond valuation. Now, duration related, what you're supposed to know, what can be asked as a part of MCQs. Duration immunizes your portfolio if and only if there is only one interest rate change. If there is more than one interest rate change as such, guys, duration will not immunize your portfolio. There was one question in which we changed the composition of portfolio on a later date. We invested, say for example, when the yield is 10%. After that, the prevailing yield beta changed to 11%. The yield has already increased by 1%. If the yield has already increased by 1% and there is no subsequent changes in interest rates, guys, no problem. You will still be protected against interest rate changes. But if the yield is changing again, you will not be protected. So you will have to change the proportion of your portfolio. Do you remember this? Very important beta. If there is a question on interest immunization, they are going to ask you this. What if beta you have one security whose duration is 1 year, another security whose duration is 3 years, and you want a duration of 2 years? Weighted average. You will have to combine both the securities as such, guys, and ensure that the average duration is equal to 2 years. They might give a case wherein they are giving us multiple securities. There were two questions that we did. One, there were 3 securities. One, there were 2 securities. We had to combine both of them as such beta and create a portfolio whose duration is equal to your investment period. Is that clear, kids? Any doubt in this? After this beta, we moved on to the concept of convertible securities. I already told you better under valuation as to what is the value of a convertible security. It will always be what, guys? Present value of coupon payments plus present value of redemption value or conversion value, whichever is higher. Now, I said we should compare a convertible debenture with a non-convertible debenture. A non-convertible debenture gives you fixed income. An equity share will give you capital appreciation and variable income. A convertible debenture is combining the benefits of both non-convertible debenture as well as equity shares. Till that convertible debenture gets converted into equity shares, you will be entitled to fixed coupon payments. And in case the value of the equity shares is increasing as such better, you will be entitled to capital appreciation. That is where I told you that the value of a convertible debenture will always be greater than the value of a non-convertible debenture, or guys, it will always be greater than the value of equity shares also, as on the current date. If say convertible debenture gives you 5 equity shares and the current market value of those 5 equity shares is 100 rupees, anyone will be willing to pay a premium for a convertible debenture. The value of a convertible debenture is going to be more than that 100 rupees, today's value. Is that clear? So in relation to convertible security, guys, they will give us the market price of a convertible security in the question. If they are not giving us market price, they will give us the basis to compute market price. That is redemption value or expected conversion value on maturity, whichever is higher. Yaad hai nahi hai? Now, there were 1 or 2 questions in which they did not give us expected conversion value. If they did not give us expected conversion value, I said we do not have an option. We will directly write present value of coupon payments plus present value of redemption value directly. There is no conversion that you will take into consideration. So the first concept that we have learned in relation to a convertible security beta was a straight value of a bond. Straight value of a bond, guys, is value of a bond as such beta ignoring the conversion option. Or what will be the value of a non-convertible debenture? Correct, Niharika? So the value of a non-convertible debenture is straight value of a bond. On a higher side, your convertible debenture beta can reduce to straight value. This is why the difference between these two is called as downside risk. I'll come to conversion premium later. That might be the order in which I explained in the class, but this is called as your downside risk. Say guys, market price of a convertible bond is 125 rupees, but the straight value of a bond is 90 rupees. Even if the value of equity shares is reducing, your 125 rupees will only reduce to 90 rupees. This difference will be called as what? Downside risk. If they ask us to compute downside risk in percentage, what will you do? Divide 35 rupees beta with 125. I told you beta. Sorry, you will divide 35 rupees as such guys by floor value. I said logically as such guys, you're supposed to divide it by 125 rupees. But then as per ICAI beta, we divide 35 by 90 rupees. Always remember that. So the other concept that we did in relation to convertible securities was conversion premium and conversion value. This conversion value is not as on the maturity date. This conversion value is as on the current date. Let us say beta that this convertible bond whose market price is 125 is going to give you 5 shares and the market price of each share is 20 rupees. So as on the current date, what is the value of those underlying 5 shares? 100 rupees. The value of 5 shares is 100 rupees. Market price of the bond is 125. Instead of buying 5 shares, you purchased a convertible debenture. To buy that convertible debenture, how much premium did you pay? 25 rupees. That is called as conversion premium. In case they ask us to compute conversion premium in percentage, what are we going to write? Divided by conversion value. You're going to divide that 25 rupees by 100 rupees. Are we clear about this? After this, we moved on to under convertible securities only. We did downside risk, we did conversion premium, conversion value, downside risk in percentage. Then we did beta favorable income differential. Favorable income differential only, no? Conversion premium ho gaya, straight value ho gaya, downside risk ho gaya. Conversion premium also done. So favorable income differential guys is, instead of buying debenture, you have purchased, instead of buying equity shares, you have purchased debenture. What would have been the dividend income that you are getting if you are buying equity shares, and what is the interest income that you are getting from debenture? The difference of these two is called as your favorable income differential. In one question, beta, debenture was convertible into 30 equity shares. Dividend per share was 1 rupee. So your dividend income would have been 30 rupees. But that debenture was giving you a coupon of 85 rupees. What is your favorable income here? 55. Because you purchased a convertible debenture and you did not buy equity shares, you are getting a higher income. And that higher income beta is 55. Here in the example that you see on the screen, dividend income is 30, but interest amount is 100. Therefore, guys, your favorable income differential is 70 rupees. In case they ask us to compute this favorable income differential per share, you will divide this by number of equity shares. Using favorable income differential, we computed something called as premium payback period. What we are trying to compute here, beta, is the time period that we will be needing to recover conversion premium using favorable income differential. If my conversion premium is 300 rupees and my conversion favorable income differential is 70 rupees, I paid 300 rupees more than the value of equity shares, but every year I will be getting an extra income of 70 rupees. In how many years will you be able to recover that 300 rupees? 300 divided by 70. That is called as your premium payback period. Are we clear about this? So, one last concept under convertible securities was conversion parity price. I said this is the price. I said this concept does not exist in real life, better. Because if the value of the underlying equity shares is increasing, the value of convertible debenture is also supposed to increase. But anyways, the price at which you will be indifferent between holding a debenture, guys, and converting it into equity shares is called as your conversion parity price. To arrive at conversion parity price, you will take the market price of convertible debenture and divide it by conversion ratio. That is how you're going to get your conversion parity price. Are we clear about this? After convertible securities, beta, we moved on to the concept of forward rate agreement, FRA. I said a forward contract is an agreement to buy or sell something, guys, as on a later date. Yes or no? Forward rate agreement is a contract to borrow or lend money as on a later date, but the interest rates are determined today. You know what is the interest rate? It is just that the borrowing or lending will take place on a later date. That is called as an FRA. So here you should know what is the difference between spot rates and forward rate. Pretty important concept. Spot rate is the interest rate that is prevailing as on the current date. Spot rate can be for different maturities. You can have spot rate for 1 year, you can have spot rate for 2 years, 3 years, 4 years, 5 years. If it is spot rate for 5 years, it is SO5. If it is spot rate for 4 years, it is SO4. If it is spot rate for 3 years, it is SO3. Spot rate for 2 years is SO2. Using these spot rates, we have arrived at forward rates. So, if they ask us, pehle to beta notation important tha. If they tell us beta that you're supposed to compute forward rate for second year, what we are trying to compute beta is F11. It is forward rate after 1 year for a period of 1 year. Can also be written as 1 cross 2 FRA. If they ask us to compute forward rate for third year, it is F21. After 2 years for 1 year. Forward rate for third year beta. It is only for 1 year. So that is why after 2 years for a span of 1 year. That will become 2 cross 3 FRA. If they mention forward rate after 1 year but for 2 years, F12, which will become 1 cross 3 FRA. I said in order to compute forward rates, you will be needing spot rates. If spot rates are not given in the question, they will give us prices of zero coupon bond. Using the present value of prices of zero coupon bond and the redemption value, you will compute SO1, SO2 and SO3. Do you recall that? Or if they give us coupon paying bond, every year's cash flow should be discounted at a separate spot rate. If it's a 2-year coupon paying bond, first year coupon will be discounted at SO1, second year coupon will be discounted at SO2. Any cash flow that you get at the end of first year will be discounted at SO1. Any cash flow that you get at the end of second year will be discounted at SO2. Alright. If spot rates are not given, they will give us prices of bonds. Our job will be to first compute spot rates. Once spot rate is done better, let us say that you want to compute F11. To compute F11, you will need SO2, spot rate for 2 years, and you will need SO1, spot rate for 1 year. I said we will consider two alternatives. One where you directly invest for a span of 2 years, one where you invest for a span of 1 year, and after that you will again invest at F11 for 1 year. No matter what you do, the accumulated balance at the end of second year should remain same. Using this relation, we wrote 1 plus SO2 whole square will be equal to 1 plus SO1 into 1 plus F11. This will tell us what is the rate beta that is prevailing for the second year. Whereas if they ask us to compute F21, 1 plus SO3 whole cube will be equal to 1 plus SO2 whole square into 1 plus F21. This is investing at spot rate for a period of 3 years, or investing at spot rate for 2 years and then investing at forward rate for the third year. If they ask us to compute F12, 1 plus SO3 whole cube will be equal to 1 plus SO1 into 1 plus F12 whole square. This is how you will be arriving at F12. Are we clear, guys? After computing forward rates, or if they give forward rates in the question, you should know how to compute price of a bond. First year cash flow discounted SO1, second year cash flow discounted SO2, third year cash flow discounted SO3. इसके बाद में if they ask us to compute YTM, what will you do? Age old shortcut formula. YTM will now be an average return beta for the entire bond. SO1, SO2, SO3 are yields for those specific maturities. But YTM will become an average rate for the entire period of bond. Again, important guys for your MCQ. Any question of AFM beta can be easily converted into MCQ question. This is why the questions of MCQs are not that complicated as of now, unlike the other subjects. On other subjects में बेटा it's not that simple to just convert any question into an MCQ question. यहाँ पे इतने ज़्यादा requirements रहते हैं. They're not complicating MCQs. They're simply converting the same question into an MCQ question. Are we clear about the concept of forward rate, guys? After forward rate beta, we moved on to the concept of yield curve. I said beta yield curve. एक second beta, let me just go to that. So yield curve beta is where all the interest rates are plotted on a graph. Depending on the shape of the yield curve, guys, we have 4 types of yield curves. What are those beta? You will have an upward sloping curve. That's a normal yield curve. An upward sloping yield curve beta means that shorter duration bonds will have a lower YTM, longer duration bonds will have a higher YTM. As the maturity period keeps increasing, the YTMs will keep increasing. A flat yield curve as such beta would mean that irrespective of your maturity period, the YTMs are not changing much. I told you beta, not now. A couple of years back, Japan had a flat yield curve. The interest rates more or less beta were same. A downward sloping, also known as an inverted yield curve, is where beta the interest rates are decreasing with an increase in maturity period. So shorter duration bonds have a higher YTM, but a longer duration bonds as such guys will have lower YTM. When will you see a downward sloping yield curve? Hyperinflation. This is where short-term interest rates are abnormally high, guys. I also gave another situation wherein industry is expecting a recession. So we expect that the long-term interest rates are going to decrease. Which economies will normally have an upward sloping yield curve? Developing economies are going to have a upward sloping yield curve. Very developed economies with huge supply of money as such beta will have a flat yield curve. And then there was another yield curve beta called as humped yield curve. Initially the interest rates are increasing, but after that as such beta the interest rate starts decreasing. This happens when we are expecting that for a medium term we expect interest rates to be higher, but after that beta there will be a decline in interest rate. Say if the inflation as such beta has become very sticky, that means inflation is going to remain around say for the next 4 years, 5 years. So you know that short-term interest rates would be elevated for the next 4 or 5 years. After that you might start seeing the ease in reduction. So that is where beta you will have a humped yield curve. Is that clear? To explain guys the nature of these yield curves, we did term structure theories. Notes mein tumhare? Yeah, nahi. It will be in your notes guys. We did something called as term structure theories. The first one was expectation theory. I said as per expectation theory as such beta, the shape of yield curve will depend on how the investors think that the interest rates are going to change. So according to this theory, any type of yield curve is possible. They can ask all of this in MCQs also. As per expectation theory beta, we can have any shape for the yield curve. As per liquidity preference theory, you can only have an upward sloping yield curve. When I say upward sloping yield curve as such guys, as per liquidity preference, Higher the maturity, higher will be the risk. Lesser the maturity, lesser will be the risk. That is why bonds with higher durations are supposed to have higher yields. Bonds with lower duration should have lower yields. So as per liquidity preference theory, you will only have an upward sloping yield curve. That is normal yield curve. The last one beta was preferred habitat theory. As per preferred habitat theory beta, the interest rates that prevail for a specific maturity will depend on demand and supply of money for that maturity. If the demand is more as such beta, then the interest rates are going to be high. If the supply is more, the interest rates are going to be less. Iske alawa, we also did beta factor of a bond. This was combined only with those questions where forward rates were given. I said beta talks about beta the popularity of a bond. If a particular company is more popular than others, in spite of having the same credit rating as such guys, it may have a higher price. People might be willing to pay a higher price for that. So if beta is 1.05, I told you that means the bond will have a price of 1.05 times than that of the price of a similar bond. But uska YTM beta, will that be lower or higher? Lower. Because the bond is trading at a higher price, the YTM of the bond will be lower. After this beta, we moved on to the concept of bond refunding decision. I said this is in respect of callable bonds. In case a company wants to redeem the existing callable bonds guys and issue new bonds, what will the company do guys? They will have to evaluate the NPV of bond refunding decision. 4 major items that should affect your decision. The first one is savings in coupon, next is call premium, next is flotation cost of new bonds, next is flotation cost of old bonds. Talking about the first thing guys, obviously a company would want to redeem their existing bonds and issue new bonds if the prevailing interest rates have reduced. So you will have to take the difference in coupon amount, net of taxes, and discount it for the entire maturity. If the new bonds have a coupon rate of 6%, old bonds have a coupon rate of 8%, my saving in coupon will be 2%. I will have to take this 2% net of taxes and discount it for the next 20 years, 25 years, whatever is the maturity of the bond. Moving to the second aspect, which is call premium. If you're redeeming the old bonds at face value, there is no expenditure. But if you're redeeming the old bonds at a premium, whatever is the premium that you are paying as such, beta Saurav, जो भी सुन रहा है बेटा, सौरभ गुप्ता, whatever is the premium that we are paying for the bond as such beta will be your expenditure. Will this be immediate outflow or will this be outflow over multiple years? Immediate outflow. Will you get immediate tax savings or will you get tax savings on a later date? Immediate tax savings. Because you're redeeming the existing bonds and they do not remain in existence beta, you're going to write off the entire call premium immediately. So call premium will result in immediate tax savings. Call premium should be considered as outflow and tax savings also will be immediate inflow. After that beta, when you talk about flotation cost of new bonds, are you incurring this amount immediately or are you incurring this on a later date? Immediately. But will you write off this amount immediately or over the maturity of bonds? Over the maturity of the bond. So this is the difference between call premium and flotation cost of new bonds. Call premium results in immediate tax savings, but flotation cost of new bonds will result in tax savings over the maturity of the bond. So you should take present value of those tax savings rather than directly writing minus tax savings. Flotation cost of old bonds is not an outflow anymore. That is sunk cost already incurred guys. But that amount is being written off over the maturity of the bonds. If you redeem the existing bonds, you will be able to write off the entire amount immediately. If you do not redeem the existing bonds, you will have to continue to amortize it over the life of the bond. So though you are gaining immediate tax savings, you're also losing tax savings that you would have got over the maturity period. That will be considered as opportunity cost. So immediate tax savings will be considered as inflow. Opportunity cost as such beta will be the amount that you are foregoing. Take all of these factors guys, and then if the NPV is positive, you should be refunding the bonds. If the NPV is negative, you should not be refunding the bonds. And do not forget beta, सिर्फ ऐसे बोलने से it is only to revise what should be considered. Unless you solve question on this, you will not be able to figure out. There was one question in which old bonds not only had flotation cost, they also had discount. I said the treatment is same. And plus there was one more question in which there was overlapping interest for 2 months. I said, right, with the new bonds, what is the interest outflow? Without the new bonds, what is the interest outflow? You will automatically know how much will be the incremental cash inflow and outflow. And if they do not give us discounting rate, what is the discounting rate that we should consider? After tax coupon rate of the new bonds. If the new bonds have a coupon rate of 8% and tax rate is 30%, you will take 8% into 1 minus tax rate, 5.6%. Out of the 3 questions that we did in the class, only in 1 question they gave after tax cost directly in the question. In both the other questions we had to compute. We took after tax cost of coupon rate. याद आ रहा है क्या बोल रहा हूँ? Do not forget this point. If discounting rate is not given, it is always to be new coupon rate beta net of taxes. After bond refunding decision, guys, we moved on to the concept of money market instruments. Under money market instruments, I said because these bonds have a maturity of less than 1 year, they are bonds for shorter durations, there will be no concept of coupon rate. These bonds or securities beta will be directly, did I miss something, Vedika? These securities will be directly issued at discount to face value and will be redeemed at face value, par value. But there are 2 terms that you should know in relation to money market instruments. They do not deal with this in relation to long-term bonds. Yield and discount. For long-term securities, we never use the word discount. It is only for money market instruments that we use the word discount. So if you see the example better here, face value is 100 rupees, issue price is 97.5. The bond has a maturity of 6 months. I can say that the return of an investor is 2.5 rupees on an investment of 97.5. If you're computing yield, it is always as a percentage of purchase price, the amount that you are investing. But if you talk about discount rate, it is always as a percentage of face value. यहाँ पे discount rate will be 2.5 divided by 100, but yield will be 2.5 divided by 97.5. This will be the difference between yield and discount. Even if they ask only yield or discount, they are not expecting you to compute yield or discount for 1 month or 2 months. You should always write annualized answer. If this is for 6 months, you will write into 12 divided by 6. Do not compute effective annual return unless they ask. Are we clear about this? Remember how to compute discount. Remember how to compute your yield. Is there any doubt in this, guys? Yes or no, beta? After computation of yield and discount, guys, I spoke about bond equivalent yield beta is the wording that we used in one of the questions. What is bond equivalent yield? Annualized yield. If they give us yield for 3 months, you will write into 12 divided by 3. That will become your bond equivalent yield. Nothing else, guys. Now, we did the concept of repo transactions. For that, first I explained what is clean price and dirt price. Clean price of a bond as such beta is the price of the bond excluding accrued interest portion. Dirt price of a bond, guys, is including accrued interest portion. In case they give us clean price, all you have to do is add accrued interest, you will automatically get dirt price of a bond. Repo transaction is a transaction under which one bank beta is selling government securities to RBI and is entering into an agreement beta to buy back the same bonds on a later date. Repo transaction goes up to a maximum period of 14 days as such, guys, from 1 day to 14 days. Apne pure examples were less than 14 days only. So you are selling securities to the banker beta RBI and then you are buying back the same securities as such, guys, from RBI on a later date. That is a repo transaction. Now, under a repo transaction, you sell government securities. When you're selling government securities, they will not offer the entire amount as loan. What they will do beta is keep a certain amount of margin. If they say beta that initial margin is 2%, the amount that will be given to you today will be 98% of dirt price. Fair value, that is dirt price. In case beta clean price of a bond is 98 and dirt price is 105 and margin is 98%. Sorry, margin is 2%. They will give you 98%. 98% of what amount? 105 rupees. How much will this become beta? 102.9. They will be giving you an amount of 102.9 rupees. Margin is not your expenditure. You are getting a loan of 102.9. This plus whatever is the repo rate interest is the amount that you are going to repay. This is how you are going to get the amount. They can ask us to compute dirt price of a bond using clean price, or they can ask us to compute clean price of a bond using dirt price. They can ask us to compute first leg payment or second leg payment. What is first leg payment? What we receive at the inception is called as first leg payment. What is the amount that you are going to repay as such beta is called as your second leg payment. The difference between these two as such beta will become the interest that you are offering. I also told you, do not confuse the coupon rate of government bonds with repo rate. The underlying bonds that you are exchanging can have a coupon rate of 9%, but repo rate can only be 6%. That 9% is irrelevant to us, only relevant to compute accrued interest, if accrued interest is not given. But the actual interest that you will be giving to the other banker as such beta will be based on repo rate of 6%. It will not be based on coupon rate of the bond. Coupon rate is only to compute dirt price. Thereafter coupon rate is irrelevant. Are we clear about this? इसके बाद में बेटा we did two small concepts. One was valuation of preference shares. The other one was valuation of share warrants. Under valuation of preference shares, guys, I said it is exactly similar to a coupon paying bond. So to arrive at the value of a preference share, guys, all that you have to do, guys, is take all the future cash flows in the form of preference dividend and redemption value and discount those cash flows. It can either be a redeemable preference share or it can be a perpetual preference share. It can be a convertible preference share. It cannot be the other one as beta that we have. कौन सा था? Deep discount नाम का कोई नहीं है guys. You can have a coupon as in fixed dividend, or it can be irredeemable, or it can be better दूसरा क्या? Convertible preference share. In any of the three cases, guys, the value of that preference share beta will exactly be the same as the value of a debt security. Then the last concept was valuation of share warrants. A share warrant is an instrument against which the holder is entitled to buy shares at a predetermined price as such beta. If the share warrants have an exercise price of 20 rupees, the holder is simply supposed to give 20 rupees to the company and take the equity share. To arrive at the value of a share warrant, you will have to take n multiplied by market price of equity shares minus value of share exercise price, guys. If exercise price is 20 rupees and current market price is 100 rupees, against each share, the holder is getting a benefit of 80 rupees. But a warrant can be for more number of shares. It need not be for one share. If the warrant is for 5 shares, the total benefit beta that the warrant holder is going to get beta will be 5 shares multiplied by 80 rupees. That will become 400. This is how you're going to determine the value of a share warrant. These are all the concepts that we have covered in bond valuation. Do not forget, this is not a replacement to studying. If you've already done your classes properly as such beta, whenever you're going to revise later, one year later, 1.5 years later, listen to this, go through all the concept notes first, because concept notes also have examples. After that, if you start preparing, you should be able to solve a majority of the questions on your own. Every नए concept पे बेटा first question you might have to refer to the solution once, but thereafter make it a habit that you're solving the questions without referring to solutions. If you're able to do that, there is no one stopping you from scoring 80 plus 90 plus in the examination. Questions are going to be similar, just that by the time we finish the syllabus, guys, there are going to be way too many small concepts that we have covered. इसीलिए the most important thing is your ability to solve questions on your own. If you're able to do that, बस है. If you're looking at the solution, looking at the question, and then you're answering it as such, guys, it's only your picture memory that works. You already have the picture of the solution in your mind as such, but you're simply trying to reciprocate that on the paper. This is where we get stuck in between. If we solve after 1 month, after 45 days as such, better. Picture memory does not work then. So try solving all your questions on your own. ये जो concept notes अलग से लिखा रहा हो बेटा, the whole objective of that is this only, that you should be able to revise them, guys, whenever you're revising before the examination, guys, or during your revision period. अभी जो exam लिख के भी आए बेटा, they were all telling the same thing, that concept notes help them a lot during their preparation, guys. मतलब हर एक subject का पहले concept notes देख लो and then go back to solving questions. It made मतलब solving faster. Now I thought I will give off these revision videos also directly, just in case you forget the explanation as such beta, you can refer to that explanation. In case we need explanation of any one concept in a detailed manner, we are not able to recollect, tell me, I'll explain the entire concept only. Clear? Chalo beta, end of the session. Enjoy your weekend. Online students, end of the session beta. Bye bye.